Hello, everybody. Welcome. You all having fun? England finally won something. I've just sent the preview through. There's a lot of charts this week, so it's quite big. Hopefully, that's not causing you lots of problems. Someone asking on the chat, reading about Nvidia is a short squeeze similar to Tesla earlier on. That's why the price is jacking up. Your thoughts? So, who's out there? Who have we got today? Julie. Yeah, everything seemed to be delayed for a minute. I don't know why. So look, door behind me. We need an ACG Super Julie sign there. Is the volume working? ACG. Excellent. Thank you, Max. Cool. Right. Let's have a look. So what are you all playing today? It's absolute data fest this week with a holiday in between, FOMC minutes, the works. We're going to have all sorts of volatility. So hopefully you've downloaded the preview. If not, I'll go through it. Gold longs for the week. I did have a good weekend, Fato. Thank you. Hopefully you did. Yeah, we'll have a look at gold. Obviously I'm long gold, but I still think it's got every chance of doing both things. The setup is right in the middle, and everyone's getting squeezed, aren't they, at the moment? But we've just hit more or less a turning spot for gold. Otherwise, it's going to go up another $20 potentially before it turns. We'll have a look at that. But I'll also walk you through why I think there's still dislocation in the gold market. We didn't quite get the end of quarter breakout. It looks like things got rolled over, but it doesn't mean it was closed out. It means that it was just pushed further back. Unfortunately, they've made the data so opaque now that it's difficult to see what's going on. But what we do know is that open interest in gold has halved over the last year or so, and that is mainly due to a lot of people understanding what's happened with the settlement side of things, and that it's no longer the manipulation game that it was. So that is going to cause issues for the shorts in holding it down. But we'll go through that. There's a July bias to trading indices in America. Particularly, the first 2 weeks of July happen to be the biggest returns period as a fortnight of the whole year since 1928. Some Goldman Sachs research on that, so we'll have a look at that. The high bar for Q2 earnings for Q2 really starts on July the 8th, so next week. So this week is all about macro data and politics. But 9% return on average for Q2 is very high, so it's going to be difficult to get a lot of outperformance from that. So it's very much a case of just trading in line with the expectations. So that allows for us to have a little bit of consolidation and range trading, which we've kind of been talking about before people settle down and hopefully break out at the end of the period. Some worries, we know, looking at data, we've got a lot of it this week. ISM is very important at 3:00. All the PMI data has been about the only positives. So far, that hasn't really come through on ISM in general. Obviously, we get a lot of price read through. China this morning on their PMIs missed, but they said that there's some goods inflation beginning to rear its head. Now, obviously, the world's disinflation has come from cheap China goods, so that could be a worry 6 months or so ahead, which obviously the Fed are going to take into consideration. We'll walk through the data fest, politics, have a little chat about what happened at the weekend and what's gonna happen this week. Just mentioned the gold issues and the dollar bias is still doing all this nesting, hasn't taken out the high, but we have to allow for the fact that there is the potential for the dollar to stay stronger for longer throughout the rest of the year. It's all about the velocity of it and whether it does put in a higher high to what was previously an accepted top. At the moment, we've got quite a bit of wriggle room, and we are expecting one more little high in the current setup. And then any questions from you guys? So what we've got out there, you've got some people, Ben A has got gold longs for the week, um, and euro shorts. Max Trades is bullish on the dollar. Ben A in France. You are in France, or you're buying into France? Hello, Vivi. So again, we might as well start with that. We mentioned on Friday's live show, if you were here, that, and I was mentioned on the chat, I thought there would be a euro rally and associated assets just because of the way the first round was likely to go. It's not really, no one's really showing their cards. And in fact, the biggest shock wasn't the sort of 1% pullback, no further progress from the national rally. It was the left didn't make any ground in the first round. So something odd going on with the way people are playing here. And it's all about, obviously, the next vote. This is where things will come in. The national rally, we mentioned it on Friday. The reason the market is a little bit happier is the fact that you can get a left coalition, but because the national rally will have so much, it's going to be a bit of an impasse. Nothing really will get done, but nobody's really going to get a big handle on that. The problem for the market and for the euro is obviously there's a lot of uncertainty about France. There's big uncertainty with the actual vote for Ursula von der Leyen getting back in and her two associates, because that vote was fudged. We talked about that on Friday. Hungary took over today, and the first thing that Orban did was strike an alliance with Austria and Czech to create a formal right-leaning bloc to try and get on the voting committee. I'd imagine Meloni will join them if they make any kind of traction. So that is going to cause all sorts of issues when that vote goes through. Because I do think that they could actually lose. So that will create some angst for the euro. And then the key thing for France, they've got to get their fiscal budget in by September. There's a good chance that that is all over the place with extended political haranguing. So that again will lean on the euro towards the end of Q3. So lots of angst ahead for the euro, even the fact that we think it's close to a short-term bottom. But we'll have a look. Their pattern has changed into a slightly wider consolidation with the way that the rally's played out. We'll have a look at that. UK, what's going to happen there? Sterling potential strength if Labour don't get a massive majority. I mean, it's going to be big enough. It's all about how short the net distance is. There's lots of nasty media going on just to try and scare everybody. So we'll see where that ends up. But 200 plus sterling probably anywhere below 200 as a majority would be sterling positive, I think. What we've got outlook on US indices and your signature Elliott wave analysis is what I'm looking forward to. Okay, that'll be coming. Oil related to inflation. There is potential for that. I think that will be capped. There's only potential in the patterns for a little breakout, but I think there's a supply issue for oil. Unless demand really picks up in China and India, then inflation from oil will probably be contained going into the US election. Both candidates would do the same thing, and Biden is making sure they're pumping their special reserve like crazy. So I think they're going to try and keep a lid on it as a way of trying to combat some of the inflation there. Oh, so we've got a Vivi imposter in the chat. Who's that? Let's have a look. That's probably the old troll, Vivi, your mate. If it is, find out who it is, I'll ban them. Max Trades, was I a broker? Do I actually trade or just do analysis? Yeah, been a broker, trader, analyst for 30 odd years. Worked for UBS. There should be some bio videos about me doing interviews with Drew, etc., talking about all that. But yeah, I was at UBS. I was on the life floor before it went electronic as a runner, doing various structures there, but mainly a market maker in pan-euro equities for most of the time. And I went to Liberum Capital. Don't know if you've heard of them. When we started that up in the middle of the crash, GFC, and then Peel Hunt. Started off at Sunalliance Investment Management at the other side, so a lot of analysis background from that, and that's where I bumped into a technical analyst chap who was into Elliott Wave, who taught me, and he was a big PA trader, but he's also a fund manager. So that was a good start. But I started in bonds, and because I've got a bit of an economics background to start with, that really cemented that. And obviously, when you analyse companies as well from a bond perspective, you've got to be really sure that they're going to survive. So that gives you very good insight into it. So we have got Alex. Also was in the broking world. Me from broking and trading. So yeah, we are real people. We aren't the scam artists that you see out there. There are some people involved at Alpha. So hopefully that gives you a bit of confidence. We will try and sort out any issues. And I know we've got an issue with news at the moment. We will get to the bottom of that. So where were we? So I do trade. I do trade on my own account, mainly sort of mess around just to see how the systems are working really with what you guys are doing. Um, Hello, Mischievous Apple has made it. Welcome. Welcome. Perhaps strolling around Bond Street. I thought you said you were concentrating today. You're going to be fully involved. Right. So because we've got a data fest, Euro budget's done, GBP done. Let's just run through the preview. There's a couple of nice charts that I'd like to show you there. So Nvidia obviously is, and the tech stocks, the AI side of things. And I said the other week I've been doing an analysis piece for someone on an AI stock, and the amount of money that is coming in to take stakes and funding rounds for anyone that has actually proven concept is still absolutely amazing. It's not as high as 2021, but it's still way above the average run rate. So these people are growing their earnings. If you can prove your concept, this thing is still mega viable. You're beginning to get higher multiple ratings, which they're going to have to grow into. They have to make those earnings. And as we've seen already with things like Micron, anything that's just in line is going to get punished in this earnings season. So that kind of tells us that we're probably going to be in a consolidation pattern once we put this next top in. And where is it? I just mentioned briefly, there's some things that some people will seize upon and start saying that the economy is rolling over. And when you've got things like Nike down 20%, Lululemon struggling, had that Boeing debacle the week before. But these aren't for economic reasons yet. They're mainly self-harm. Nike's strategy was rubbish. Pin the market. We're not doing shares yet, but we will do. It is in the pipeline, sort of second division pipeline to come. Not an immediate startup, but that is the plan. So things aren't fraying at the edges. It's self-made, or as with Boeing, their demand is record demand. They just can't fulfill it because they can't get all of the technical parts. Well, that will eventually sort itself out, but it shows you that there's underlying strength. And that also is another reason Boeing, which is aircraft demand, why when we're looking at durable goods and investment spend, that we do the Jordan, the Air Jordans, no defense. So it's X Airs. Without, you can't see his trainers in a picture that we use. And there's usually no defense to a Michael Jordan slam dunk. So that's the reason you look at that. Durable goods, X Air, non-defense, because they're so bulky and you can have these issues. So you want to get those removed so that you can look at what the actual underlying investment demand is. So that's the reason that you get sort of 67 figures. That's the one you want to look at. You can see what outperformed, we know that the Japanese yen is under pressure, US dollar, Japanese yen has been the outperforming currency, up 13% year on year, and if you actually look at the indices year on year, the big outperformer is the Japanese yen at 20%. So if you go into that unhedged, then you're only up 6%. You've lost best part of 14% on the currency. That means people are going in there hedging. That's sort of like a self-fulfilling circle. You've got people selling the yen on top of investing. What you really are looking for is when they eventually sort it out, they'll start getting big inflows back into Japanese shares, is when you invest in a country and that local currency goes up, then you get a double whammy. Fortunately for the Japanese, it's gone the wrong way, but the Nikkei is still strong. The big weights in that index are still the exporters. They're beginning to invest and put capital aside for some big tech stocks, but it hasn't really happened yet. Fato, there is, yeah, that Sprint thing is finally sorting itself out. Has been an overhang in the stock. Blah, blah, blah. Yeah, good spot. Don't know, you've all know what the performance is really on all those things. So massive week, and we've got Independence holiday in between. So Wednesday, we'll have to go through and see what closes, but there's a half day holiday on Wednesday in the States, as well as a full day one on Thursday. So volumes at the very least will slow down. Little chat there about what we said would happen with the French politics and the GBP and Hungary. So yeah, we're going into this big data week, which we'll have a look at. Known knowns and unknowns for Q3. So we know that the data has been softening generally, the retail side of things. The fundamental thing I've said, C plus I plus G plus X minus M, the aggregate demand. We've got to remember, particularly in the States, 70% of the economy is on the consumer side. So we don't really want to see that slowing down. And we are seeing flat retail spend. When the GDP figures came out, we saw reduced consumer spend, and that was an unexpected as well. That was below expectation. And a lot of the inflation measures are coming down, and in the sticky areas like insurances, healthcare insurance, apparently on that core PCE on Friday, if that had been reducing in any way, we'd have probably had a negative print or at least a zero. So that was only healthcare that held everything up. Airline fares were dropping, and what hasn't dropped yet is the rents. Which websites do I use to find my data? You can go to my chat and look at the fundamental ideas little document. So I've put a good starting point for you to go and look at, to where to find, and then obviously Fabo on our chat today talked about a service that he pays for. That would be very useful if you can afford it to have a look there. But you can find a lot of things on things like LinkedIn. If you follow the right people when they're releasing things, you can get stuff for free. But I should start off with a diary from investing.com, and then I'll go to the central bank websites and actually go to the websites of who actually releases the data. When you go there, you'll get obviously summaries as well as details of all the data. I would say look at the data, prove it to yourself that it's done what it's done. You can also find comments that help you read between the lines, and you see which subsectors of data are doing the movement. Then you can set up your bias as to what is affecting the instrument that you're playing in. The Feds are having post-traumatic stress is that on managing inflation before cutting interest rates. We could say that. They're getting themselves into a bit of a mess really, because by now they should be considering an emergency rate cut just to keep everything in line. If you look at the spread of what may happen, actual crazy reflation is probably your third out of three options, whereas soft landing or actually messing it up are probably quite close to each other. And if you play data dependency and you get it wrong, you're suddenly miles behind the curve, and you'll have to do a bigger cut. That's why I think when they go, they'll end up doing 50 basis points first, and you wouldn't rule it out being anytime soon if these data carry on the path they've been. And we've got your job cuts. People don't always like the household report, but I do, and I always encourage you to look at it. So non-farm payrolls on Friday, there are 2 reports: the establishment, the one that gives you the headline non-farm payroll numbers, and the private payrolls, et cetera, et cetera. The household goes into slightly different detail. That gives you the unemployment rate and which parts of the economy are in what labour force and who isn't, et cetera. And you can start to see the patterns of where the part-time stuff is. What the danger is, and I think it was Daily last week, it's in the talking heads in the thing, mentioned that the danger is that we actually start seeing job cuts in the next bit of employment. So jolts we've got again this week. We're really starting to see that roll over. Will they start to show that people aren't taking up employment as well? The opportunity is disappearing. So within that, you can go in and you want to start looking at the quits rates and the reasons for quits. So that will start giving you clues. You only generally get to see the headline jolts number. It's very important you go in and look at the other 3 or 4 things that are in that report. FOMC minutes on Wednesday night. We've spoken about this before. We saw that absolute nonsense 3 weeks later, ignoring everything that had happened and just concentrating on what must have been Kashkari's comments, which he since played down to just being his kind of outlier effect. Again, we're gonna see things. Remember, Powell is trying to create his bias in the conference afterwards and basically telling you what his interpretation of the strength of the arguments against him were, and he was saying that the narrative was still in terms of watching, but not being certainly. I think he made the comment about there's definitely not putting rates up, or that is right out there. So again, if they're discussing that, that's all it is. But there are some, Barkin made a comment on Thursday, basically saying that he wants to see data dependency, and he's not convinced that it isn't telling him that he might need to put rates up by now. And Bostic, I think it was Bostic, trying to remember what they said. One of them has pushed out. No, it must be one of the ladies. She pushed out cuts to at least 25, if not, because she talked about years. I've put them years out. So it's strange. What you must start doing and thinking now as is how the actual markets perform in terms of forward looking. Just because the Fed have gone data dependent doesn't mean the market will, and that's why they often get out of line with each other, because the markets generally look ahead for 6 months data down the line. So that puts us into 2025. Now, the consensus for 25 is probably 4 cuts quite early at the moment. So we need to really be focusing on how that's changing just as much as what's likely to happen in the short term. So if you flick around on the web and on YouTube, who's it saying? Can't remember. They've got some quite good graphics, but they're showing something that is a long-term idea, which a lot of people concentrate on. That's ISM new orders, and they've been sort of going sideways. If they don't start to pick up soon, the general correlation is that with weaker jobs data, that tends to lead us into a recession. So we're really looking for a breakout in the new orders side of things to go back to that growth trumps everything, which doesn't need the interest rate moves. So something that we definitely need to start looking at. New orders is just as important as the headline ISMs when they come out, because that's the strength of the underlying economy. Because we've had an inverted yield curve for so long, that again is normally very. I don't think it maybe once has it ever failed to lead to a recession. So a combination of those is something we need to look at. But the big thing for the inflation side of things is what happens to the rents, because they have gone into a position where they're lagging the Zori and new rents index, which are both real time, and those have had a big pullback, which hasn't been mirrored yet in the estimated rents that goes into inflation. So we've got that to come. So that it very much looks like the supply side of things is under control. Down the line, we might be getting some goods inflation, but remember that is the lower part of the economy, the lesser part. So the bias for the data fest is to the downside until proven otherwise. So the Fed have really got to start changing their rhetoric a little bit, I think, because all we're getting is we're data dependent, and if it's bad, we'll talk about it being bad, and if it's good, we'll just kind of ignore it and say we need more. And that's not good enough. People are starting to get a bit annoyed about it. Um, so more than likely the Fed put comes in there to rescue it, all of which net means that things will be underpinned as we go through Q3. So you should still that leads me into suggesting that we should be buying pullbacks as we see them. So when we go into this likely consolidation on the indices, you want to be looking to buy the three-wave pullback. And just to show that from what I talked about with the data, higher inflation is still as a tail risk on surveys, but it's now beginning to drop back. So it's just back dark blue line here. You actually seeing this or not? Da-da-da-da. Sorry, you're not on the preview, are you? Or yeah, sorry. So some of the things in the preview pack. There's this one about from the Bank of America fund manager survey. You need if you can ever get hold of that, that's really useful. There's lots of things that market reacts to, and you generally only get to hear about it hours later. But within that, they're saying higher inflation is starting to pull back as being the biggest concern as a tail risk. So that's sort of telling you that people are getting confident about those inputs. We mentioned C plus I plus G minus X minus M. Yeah, just the whole UK thing, reading through it just seems it's super ironic that we're about to vote in a party that's gonna take us back in just as Europe's going the other way. But, they'd really be better off just waiting to see how it all unfolds. Otherwise, be careful what you wish for. I did see some people on the chat moaning about volumes in a lot of the instruments, and Forex is only moving on big macro moments. I think there's a lot of chatter, isn't there, de-dollarization, the brick situation coming up in October, and I think they're gonna announce that before October. It'll be September when the BRICS probably say they're ready for the settlement currency. The rumor at the moment is 40% gold, and then a basket of all the incumbents, of which 59 have applied. I think it's about 60% of the world's population now have applied to join that currency. So clever money is probably just trying to avoid being too involved in the fiat side of exposure. Hence, there'll be people staying a little bit in cash for the moment. And then that brings me on to the gold stress situation. Hold on. Fato Yellen, I think it was what managing inflation forecast and interest rates. Yeah, she seems to forget sometimes that she's no longer in charge of Fed and that she's at the Treasury. Right, just want to run through the gold thing again because it is all over the place, and we'll go through the chart at the same time. The gold supply, remember, for anyone that's new here and hasn't heard what I talk about, since the 1st of January 2023, the gold market fundamentals have changed. Gold is a reserve asset under global settlement rules with the BIS. It never used to be. It only used to be the dollar. Obviously, it's a hard currency, but in order to qualify, you have to have possession of 85% of it, or you have to have a readily accessible claim and know which vault it's in and where it is. You actually have to own the gold. You can't just own paper chits, as they call them, paper ownership, warrants, you name it, you've got to have physical ownership. So that is 85%, and that is what is causing these big breakouts. Now, if we're about to have a settlement currency, which is also 40% backed in gold, what do you guys think is gonna happen to the price of gold? It's almost a one-way bet, isn't it? And that's kind of where we're moving towards, and then within the whole situation is you always have the Fed trying to control the gold price and inflation over the years by issuing dollars to sell gold, and it is, and by that, they put on structures so that they can try and keep their exposure down by trading down so they sell it in 1 month and buy it back in another, and they have agents putting on various derivatives. But generally, very few people ever used to settle in gold because it was a real bull's ache, as it were, to try and deliver on it. It's costly, it's big security risks, blah, 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 but now there is. The market has changed. So there's only ever 4% of contracts ever set up to deliver, but that's 4% of a very big number now, to the extent that there's more demand than gold that's being produced each year, so you're having to find it from existing holders, and obviously, a lot of those gold bars have gone into the hands of the Asian and Eastern Bloc countries, amongst other central banks. So when there was a gold standard, everyone used to have 30-40% plus of their reserves in gold, and then that fell all the way down to 10% when nobody needed to really hold it anymore. You really had America out there with absolute loads of it, 8,000 tons supposedly, but China, even though they've only got 2,000 plus official in their asset account, the whole country, via various measures, supposedly got over 30,000 tons, so they're the biggest holder of gold, it seems, or gold that they can get their hands on, and have had people pledge that they would put it towards any political regime that the Chinese leaders were to come up with. So there's a massive incentive for China and Russia to go this way because it's the only way of realizing what their holdings are. So we're in this consolidation pattern, and it's run into what's happened 2 or 3 periods, which I'm gonna show you in the chart, and the funding side of things, which is where all the stress is that people have to deliver that gold, they have to find it, and against that, you've got people manipulating the paper gold side of things, which is the market we see, COMEX, LBMA. The Shanghai physical market is always trading at a premium, but you get in this situation where people need to have delivery, and you've got offsetting sales, trying to get the price down, trying to get people to sell physical gold, and it's just not happening. As I said, whenever they go into the areas where the buying is set, and China has supposedly been hit a few times below 2,300, probably why we've not gone back through it yet, then there are some supply issues that potentially could move. So at FATO, yes, that's what I was saying, and that is probably gonna be 40% of the currency. But it's only sterling, only cable buys if England with the euros, right? Well, get your cable settled then. Shocking. If we could assassinate Gareth Southgate or lock him in the changing room, we might actually get some subs on. So we've got the central bank data coming up, which was used as a shock. Perhaps we might see that on the official side of things, China have been buying, but apparently they have been buying through a lot of their buying agents, so that may not necessarily show up again. So what is that? So we could potentially have the market selling off to put in this cathartic V-shaped low. So because they're gonna touch through physical buyers and they're gonna try and smash it through, it'll get bought up very quickly. As soon as some physical prints above that, then the market arbitrages back up. And not that there's actually any physical likely to be massively delivered. So they can get it down, but it shouldn't stay down because of this. So that still leaves me confident there's every chance that we might have that run down. And this is what is causing it. So if we look at the period from 21 to 24, you can see that there wasn't much stress. The 12 and 6-month forwards were trading more or less in line. But October 22, these started coming apart, and the 6-month rate massively dropped. Now, it's LIBOR minus GOFO to tell you what your leasing prices. This is the gold, this is GOFO. And when it gets negative, then you're actually adding on to your interbank rate, so it gets even more expensive. Shows you that it's really, really super tight. People will pay anything to get hold of it. But if you just look below, that was tight, and then as soon as this started dropping off, we got that super move up from what was a significant long-term super cycle wave 4, which started off this move up. So that we had that big move squeeze from 1,600 up to 1,800 to then to 2,000 in, um, in early 23. Then the market sold off again. As you can see, we went back to a normalization of the rate environment, and then once it started coming under pressure again, we got that big squeeze into December of 23, tried to consolidate again, and then the whole February debacle where people were super short of the physical and had to go and find it. Leasing rates went through the roof. So the only way of delivering it without actually buying it when it's impossible is that you lease it. You borrow it, you pay a high borrowing cost, which is what this is, to try and find it, so then roll over your positions. So all that's happening here is that while other people are able or happy to lend to you, you might be able to roll over the demand, fulfill the physical demand, but it doesn't go away. So the harder it is to find, that's when you get the spikes up. You're only seeing my face. What's going on? So the page I'm on is telling me that you can see it, and then it's not there. All right, let's try again. Well, I'm just going to try and close this. I've got this double entry thing again, which I don't understand. Is that showing now or not? Thank you, Pav. Lovely. Don't know why that was missing. Right, we'll go through that again quickly. M10 predictions for equities price action is the first 2 weeks of July is the best of the year. So be careful about getting too short just as you're going into earnings. But as I'll show later down, the issue we had, and it happened at the start of the Q1 earnings, we have the buybacks get paused. So remember, we've got record buybacks in the States, and they go on pause. So they close period while they're updating, and then they can buy back again once all the sensitive information's out of the way. So that tends to take away one of the key buyers. But if there's any weakness caused by that, we probably want to be buying it. So what was showing there is the GOFO rate. So generally that's in line 6 months, 12 months. There's no real issue about borrowing. If that starts getting negative or the spread between the two widens, then that's normally signs of stress in the gold market. So you got your bank rate minus the GOFO rate for what you have to pay, and if it's negative, then it shows you that you're having to pay even more. So people are willing to lease gold out, or some people are. And then if you're short and you have to deliver, then you can potentially borrow it, and then but you haven't eventually at some point got to buy that gold back to service your borrow. So it just creates and leaves this tension in the system. So it looks very much like somebody managed to lease a lot of gold into that June expiry. So all we've done, we've rolled it further down the time frame, and times are getting a little bit tight. Um, there's a lot of people who are starting to think they're about to have another squeeze like we had in February. You know, for perfect setup on the chart, the gold chart, it'd be nice to get that 2050 in, but remember June the 7th is a valid point the way that I look at things. So even though it's quite choppy at the moment, we could just be nesting and building up for a big breakout. So it's difficult to call at the moment. But I'll go through the chart and why it has reversed where it has just now in a minute. But the reason I want to have this spread thing up is if you look, just as that started blowing up in late 22, that is when gold made a significant multi-year low in the 1600s and then super squeeze twice up into that June, July high in 23. Started to normalize. So went into a sell-off pattern. Gold was easy to find, and then it bounced October, December. We had the big spike just as this thing went into dislocation again, and then again we consolidated through January into February, and then this thing blew up again. We really got the super squeeze. So there's a big correlation between GOFO and gold that is demonstrating the whole shortage of gold. So hopefully that's clear. So what I'm saying on the gold, the way I've got it set up is that this low over here on July the 7th uh, is valid, was a new low, and it was in the shape of, you could make 5 waves out of that, and we've not taken that out as yet. So that is still a setup for ones and twos, potentially from that low, nesting for breakout to all-time highs. It has been a little bit sideways. We thought it was potentially leading diagonal. We could easily have a set of WXYs. So the first 3 big waves into this low is a W. We put in 3 there. It is the X. I've changed that on the real chart. We need to put a Y in, which will again be a 3-wave move, of which, if we're in it, we are now in the set of 5 waves, which makes it interesting for the actual gold chart up to date. Has that changed? I'm just going to close these down and reopen that. So if this is an A, B, C to make the Y leg, then we shouldn't be taking out what is the top of the B leg around 23.40. So the little spike out we had, funnily enough, failed there. So it suggests there's some supply. If that breaks out, then we probably do a double, which we put in there. This is a small box here. So then we're looking at 23.55. Why is this not working? Do apologise. Super gremlins today. Don't know what's going on. Right, don't go away. I'm coming straight back. I'm just going to close my feed to YouTube. It'll come back in about 10 seconds.